Hello and welcome back to the ROI Podcast, where you're listening to two professionals, very serious professionals here today, ladies and gentlemen. The Unemployed Value Degen is here with me. We're going to bask in his glorious stock picks, many of which have been multi-baggers. I'm a simple man, so when I receive a notification in my inbox from Steve, I usually click the buy button and do all the things I tell people not to do. But in the case of Open, that was a very profitable thing for me. I can't tell you a thing about the company, but Steve will, and we're going to touch on that today. Steve, welcome back, mate. We're going to touch on the options market, where normally the guy on the other side of the table, the house, the casino, who's writing the options and getting paid week after week, month after month, that's where I like to be. But you sent me a DM earlier in the week saying that, you know what? The script has flipped, and the buyers are the ones making the money on average at the moment. Talk me through this and tell me what it means, Stephen. Break it down for me.
Yeah, let me put up a picture because sometimes that's worth a lot more. Let's see.
Mi casa es tu casa. Can you share screen? Here we go.
Yep. Are you seeing
There
that?
it is.
So this is one of those graphs that was going around Twitter, and I saw it and I was shocked, and nobody retweeted it. And it was one of those things that how can people not be seeing how big of a combo breaker this is? This is from the beginning of options. It has been on average a transfer of wealth from people who buy options to the people who sell options. That's just been how it has worked on average from the very beginning. And last quarter, that flipped. Last quarter, for the very first time, on average, the buyers made money off of the sellers. And it's not that it's bad to sell options. If you have a stock and you want to exit and you sell a covered call, then you do fine. That's you implement your strategy, you get paid a little bit. It's fantastic. But what's happening right now is that the implied volatility ends up being so different from the realized volatility. So for example, there's an earnings call coming up and the options are priced saying this company is going to have a 9% move on earnings. And it doesn't have a 9% move. It has a 25% move. So people who bought that option thinking it was going to move 9%, well, it moved 25%. And the option was dramatically underpriced. And the buyers of the options made money. And
So
right now,
move any further, this is where if you're writing the options, you want to sell volatility. So you want to sell a higher implied volatility than the realized volatility. But now, of course, you're saying the script has flipped a little bit and people are not pricing in the volatility the way they should be. And the Nassim Talebs of the world that are buying these options with a low win rate but a high expected payout when they hit, apparently are doing very, very well. Is that fair to say?
yeah. And this has not happened before. Not on a broad enough scale that it takes the entire options market and flips it to buyers making more money than the sellers. And right now it's a combo of one. But when something happens that's never happened before, it's really worth looking at. And I'm asking myself, why is this happening? And my best guess is that 0 day to expiration options have been around for long enough now that somebody sophisticated has figured out how to use them, that when there is a move in one direction, how to really push it farther, how to take that 9% implied volatility and turn it into a 25% realized volatility. And what this means is there has never been better dips to buy. So if there's a company that you know what you own and you've researched, and then on an earnings call, it has a mediocre earnings call, but then it sells off 40%, then you have a window to grab it with both hands. And just let me share. So just as an example of that, this happened to Crocs, right? So last earnings call, Crocs went from trading at $101 to $75, right? That's a 25% move. And this was their highest revenue earnings call in the company's history, right? They did fantastic. They knocked it out of the park. Now they sandbagged, they guided a little lower, but it didn't deserve a 25% sell-off. And so I wrote about it that night for Substack and said, you gotta grab this thing with both hands. This is amazing. And then since that time, it's already retraced that gap 50%. So again, it's this world where on that earnings call, nobody could have predicted that on the highest revenue that they've ever had, the stock sold off 25%, because the options going into it didn't imply a 25% move. They implied a 8-9% move. And if you're not into buying these lottery ticket options that expire, I understand, but this is just a fantastic time to know what you own and then have, small positions in a lot of things. And when these options buyers push a stock around, it makes these dips that you can just grab on with both hands.
Yeah, so a couple of comments here. First of all, I know some guys, they literally, all they do is sell 0 DTE options, so 0 days to expiry. And what they do is they sell these kind of iron butterflies, and they just watch it for about 1 or 2 hours until the theta starts to decay for 1 or 2 hours, and then they exit and they take like 20% of their target profit, or they have their stop loss rules. And on the other side, you've got these guys absolutely, I guess we used to consider it gambling, where you just buy a 0 DTE call option and it pays off or it doesn't pay off. In this case, it sounds like the gamblers are doing very well. Why did it sell off so much on earnings if you're saying they had a record revenue? Was it just because the market had priced in a higher level of earnings?
Well, there was two things. One is, and I write about this in a lot of my small cap finds, and people fight me about this on Twitter, and they say, no, the algos figure it out. The algos are more efficient than that. They had a non-cash write-down. They did a goodwill impairment. So you do a goodwill impairment by generally accepted accounting principles. That is a net income hit, but it's not cash, right? The book value shrunk by a few $100 million, but the company didn't lose any cash. They had done an acquisition a few years ago. So this is, again, they bought a shoe brand called Hey Dude, which I think is more of a Jimmy Buffett themed shoe brand. And it was not a good acquisition. Again, this acquisition was 3 years ago now. They wrote down the goodwill. And again, people will fight me in the comments when I write an article about this, that these non-cash write-downs are not being priced by the market accurately. But I don't think that's the cause of the sell-off. I think the cause of the sell-off is that there's somebody sophisticated. There's somebody who can pay the money to see the whole order book. There's somebody with machine learning software that can figure out, if I spend this amount of dollars pushing the price, I can make this amount of dollars afterwards. I think there's a sophisticated quantitative strategy. I think the new Jim Simons, the new Renaissance Macro has created their algorithm. We don't know who they are yet, but 30 or 40 years from now, we'll all be toasting how this person was able to do 50% a year for 20 years. I think somebody's cracked a code. And so maybe I'm wrong. Maybe next quarter it goes back to how things used to be, where the sellers make more than the buyers. But I think somebody's figured out a strategy to game the system and take what I think was a very decent earnings call with kind of soft forward guidance. And a lot of companies have soft forward guidance. They say, oh, well, tariff this, uncertainty that. So this is not the only company in the world to say the next 6 months are hard to predict. So they sandbagged guidance a little bit, not worth a 25% sell-off. I mean, this is a company, before I'm not trying to push Crocs too hard, but they're growing 30% year over year in China. And what kind of American company can grow 30% year over year in China? These guys are doing something magical with their ugly clogs. They've got these resin-injected shoes.
Come on,
What was that?
Don't be insulting Crocs. I'm a convert. I used to hate on them for probably about 2 years. And then a friend of mine said, no, try these on. There's a lot of medical professionals wear them, right? And I tried them on. I said, gee, I want to hate these things, but I can't. So Crocs are the best. They've got a brilliant brand reputation. And I think that you're right. If the new Jim Simons is listening, could you please identify yourself via private email? Steve and I would like to invest in a private placement in the hedge fund. Are you sure someone out there is not using, say, ChatGPT or Grok or something, just putting photos of the order book in some ways kind of front running the bid ask? Is that what you think's going on?
So I have heard a rumor, and this is totally unfounded, but the people that Mark Zuckerberg tried to hire for his artificial intelligence unit, that he offered them a $100 million signing bonus, and they turned him down. The only way that feasibly makes sense is if that they're the ones with the artificial intelligence program that has cracked something in the stock market. And again, this is just rumors and hearsay, but if somebody turns down $100 million signing bonus, they got to have a pretty good reason. But again, I have no knowledge about that. My best guess is that for a pattern to break that hard, I think something's going to be fundamentally different about the market going forward. And I think that's somebody's figured out how to use zero DTE options to push prices around in a big way.
Yeah, and I guess those guys are going to do very well playing that game. The rest of us will rely on fundamental valuations and yell at the clouds for a few months until valuations start to revert. But you're right. I don't see how, at least not yet, the algos can understand the difference between those non-cash impairments and everything that's reported as GAAP. So I think it's a good opportunity for gentlemen such as yourself who can dig in and find these types of things that are not appreciated just in the pure black and white quantitative analysis. Reminds me somewhat of Finance of America, where you dug through the books, and it must be nearly 18 months ago, mate, where you said this thing has more than a couple of times its market cap waiting in earnings that are yet to appear. Why don't you run us through some of the things we've spoken about over the last, say, 18 months, beginning with Finance of America? What was the thesis? Did it play out? How did it play out? And what you think the future holds?
Yeah, so Finance of America Companies was one of my silver tsunami stocks. The idea that these baby boomers have, was it $75 trillion in assets? And the way that they manage those assets for the last, 10, 15, 20 years of their lives is going to have a huge impact on capital markets. And they don't necessarily believe in inheritance. When I was a financial advisor for Merrill Lynch and you have these know your client rules, it was kind of like a bartender where baby boomers were telling me all about their hopes and dreams. And I just got to know that generation pretty well. And the dominant attitude is, I paid for my kids' college, they're on their own. And, that's fair enough. I'm not going to poke any holes in that, but that's a very different attitude than a lot of people for a group with $75 trillion. And Finance of America Companies is the market leader in reverse mortgages. A reverse mortgage is a very niche product where, say you own your house free and clear, which I think right now in the US, 53% of houses don't have a mortgage on them. And this is an enormous amount of wealth. Senior citizens, people over the age of 65, have $13 trillion of home equity. That's bigger than the market capitalization of the stock markets of Japan and Germany combined. Just the amount of home equity that 65-plus-year-old Americans own is bigger than the market capitalizations of two of the larger stock markets in the world. This is just an enormous asset class. And as people age, their bills start going up. You have just inflation, cost of housing insurance and your car insurance and your medications and your medical bills. Just bills keep going up. And the median 65-year-old has zero retirement savings. The median 65-year-old American has no savings, but they own their house free and clear. So a reverse mortgage company will go to them and say, we'll send you $1,500 a month in the mail for your house. We'll just direct deposit into your account, $1,500 a month. And it's going to create this home equity lien, this reverse mortgage on the house. And the rule is, after you pass away, within a year, your estate has to sell your house and pay off this mortgage. And for the senior citizens who want, that extra $1,500 a month goes a very long way toward people that do not have, a nice fat 401k and they don't have this retirement income. So it's, I think, just a secular tailwind. Their ability to sign up new customers for this thing over the next 5 or 10 years is amazing. But I think this gets into what the algorithms know about a company, what they don't. When you really dug into the details, there was something kind of magical going on with the books, and it had to do with the inverted yield curve. So the way these reverse mortgages worked, they're charging floating rate as if you do an adjustable rate mortgage. So the interest rates on these reverse mortgages were like an adjustable rate mortgage, which means they were charging something like 7.5%, which, that's relatively high. But you got to keep in mind that when somebody's 70 years old and they start this thing, the mortgage amount starts out pretty small, $1,500 a month at a time. The interest payments start out very small. The loan to value on the average reverse mortgage after people have been going for years and years and years is only 43%. And as the house prices appreciate, there's more and more that they can take out of the house. I look at it as a pretty good mutually beneficial product for these old people. But the way the money works is, to get the money to send these people a check in the mail, they bundle up this home equity and sell it as a mortgage-backed security. That's how they get the money to send them a check in the mail, is they're selling the home equity in a mortgage-backed security. But these are some of the most desirable mortgage-backed securities because the loan to value is so small. If it's a brand new mortgage, the loan to value is 95%. Their mortgage-backed securities are 43% loan to value. So these are the safest, most desirable mortgage-backed securities. And they do them on a 5-year fixed. So there was a 3-year window where they were paying interest on these mortgage-backed securities of 3.25%. And they were receiving interest on the adjustable rate mortgages, 0.5%. So this company for 2.5 years was clipping 4.25% arbitrage on $7 billion. And it was right there in the numbers, in their investor presentation. And what was so amazing about it is, on the earnings call, they tried to explain it to the analysts, and the analysts didn't get it. And I'm a former professor. One of my students works as an analyst in one of the big institutions that covers Finance of America companies. And I called him. I said, can you call your colleague that covers this company and ask them if I'm right about this thesis? And he did. So he calls up the analyst on the phone who's covering Finance of America companies and explains this arbitrage to them, and they don't get it. And he tries to explain it again, and they don't get it. And I was shocked that it was right there in black and white in their earnings presentations that they were clipping 4.25% on $7 billion, and the company was trading at a $50 million market cap. It was completely insane. It was just one of those, there's a $100 bill lying on the ground and you can pick it up for $5. Like, it was just nuts. And the story hasn't fully played out yet. It's not really pricing in the silver tsunami. It's a more than a 5x since I wrote about it. But the secular tailwinds, the money and residuals that are still going to come into them, the efficiency gains that they had when they tightened their belt, it's still it's not as early days when it was $5 a share, but it's still an amazing company that with a huge room to re-rate. I think it takes 2 or 3 years sometimes for a stock to re-rate and really convince the market that the danger is gone.
Yeah. And look, I can understand, because I didn't get it the first time you tried to explain it to me, when I think it was about 40 million. But one, that's what I've got you for, mate. That's why I pay the Unemployed Value Degen subscription. And two, it's because reverse mortgages really aren't a thing in Australia. Like, our mortgage market is, well, anyway, it's its own special beast. Couple of comments. Silver tsunami really makes a lot of sense, and where those capital flows are likely to end up is a humongous opportunity that one would expect is relatively tariff proof, because it's mostly going to be spent domestically inside the United States. And speaking with Uncle Rick on a podcast that we did, he expects the mortgage market to remain fairly sleepy, with the exception of the reverse mortgage market. And he's got a lot of experience in that area. And I think that Finance of America obviously has a huge, I guess, first mover advantage. Is there anyone else that's come into the space that's seen the success so far and thinks to themselves they might like a piece of the pie?
Yeah, so there is competition. There are some fintech firms trying to get into it. It's not a secret, I think, in the industry that this is going to be a big deal. Now, Finance of America companies, when I wrote about them, they had 37% market share. But at the same time, they were struggling. They had a terrible balance sheet, and they reduced advertising a bit. The company that has been taking market share the most, who's really been doing a good job, is Mutual of Omaha. And I don't think, it's not a public company. You can't really buy them. But there is going to be a fight over market share for this niche market. But I think the market is going to grow so much that everybody's going to feast in it. And as far as the fintech companies are concerned, when you're dealing with a reverse mortgage, a lot of times you're dealing with a widow. You're dealing with a 72-year-old woman who's lost her husband. Because the baby boomer generation, the husband tends to be about 4 years older. and tends to pass away about 6 years younger. So the average American baby boomer woman has to plan on being a widow for 10 years. And it's not universal, but a lot of them were not in charge of the family finances. And just, gender wise, they tend to be more risk averse. So this is a group of people that are not accustomed to doing things by themselves. They're somewhat afraid. And you see, so the marketing for Finance of America, it has changed now, but they had a marketing campaign with Tom Selleck. And it was just this classic thing where you're targeting widows. You take this very trustworthy, sexy looking older man. I think he may have aged out of their marketing campaigns now that they've moved on. But how do you reach 70-year-olds? I think the fintech companies are going to be fantastic 20 years from now when Gen X is looking at these products. But when you're dealing with baby boomers still, I don't think the fintech competition is going to be able to reach them very well. And I could be wrong about that. I think the traditional
Thursday night
yeah,
bingo.
yeah, the traditional marketing that reaches the baby boomer is still television commercials and direct mailers. And I think Finance of America company has a decent shot at least of holding their market share. But Mutual of Omaha has a fantastic reputation. So that's probably what's attracting people is, it's a grand old company. And if you're going to be a sort of a nervous widow, that does carry some weight to it.
For sure. All right, mate, sticking with the silver tsunami, two other things that I really like of yours have been Jackson Financial and Abacus Life. Perhaps we give a little highlight reel before we move on to the next segment on Jackson Financial and Abacus Life.
Yep. Jackson Financial is the market leader in variable annuities. And just like I was mentioning about how, the husband passes away, the woman has to plan on being a widow for 10 years. The risk aversion of 75-year-old women that are recently widowed is through the roof. Then these variable annuities, the returns on them aren't great. And so for people like us who are picking our own stocks, it seems like a terrible investment. But for the most risk-averse cohort on the planet, to have an insurance company, a reputable insurance company say, we promise you that you won't lose money, that's a very powerful thing. So I think what happens is these 75-year-old widows go down to their local bank branch, and within the bank branch, there's a financial advisor. And the financial advisor, he's somewhat disinterested which company they choose, except that Jackson Financial pays the highest commissions. And this is Charlie Munger used to go on about this. You ask an economic student, how can you raise prices and sell more of something? And he says, oh, well, there's things like Peloton. There are these niche cases, but the normal way is you bribe the purchasing agent, right? And that's how the world really works. And so they are also the quality leader. They have the most a la carte options, and some of their a la carte options are very popular, like a death benefit. They have the highest ranking for does a human being answer the phone and talk to you for customer service. So they are a quality leader, but they're also they're not a low cost. They're a high cost option that pays the highest commissions. And that has led to Jackson Financial being the market leader, the number one spot for variable annuity sales. And it's it's assets under management. You figure they're going to clip 1% a year on assets under management, and they have $300 billion of assets under management. They're going to have profits of around $3 billion a year, give or take. And the risk is they have these derivative hedges. What happens if there's a market crash? They blow up their book. And everybody's afraid of the 2008 scenario. But we've had some stress tests with rising interest rates, and we've had some stress tests with market crashes. And their derivative hedges have worked just fine. So I think there's a lot of people who are afraid of the company blowing itself up. And I think these bean counters at Jackson Financial are doing a good job. You can obviously limit the position size if you're afraid of it, but there's room for Jackson Financial to 5x over the next 5 years. And I have a little video with a spreadsheet where I go through all the math. But it's just a fantastic business. And Abacus Life is much smaller, still in a growth phase. Finance of America has room to grow. Jackson Financial, they're already the top seller in their market. The growth story isn't there. It's really just a massive share buyback story now. But Abacus Life is growing. It's a very niche market. It's called life settlements. And what happens is 90% of life insurance policies never pay out because the vast majority of people that buy life insurance You buy life insurance when you're 35 and you're worried about, geez, if I die, will my kids be able to go to college? Will my wife pay off the house? What's going to happen to my family if I die when I'm 35? But most people don't die when they're 35. They get to be 65 and they say, okay, it's time to retire. My house is paid off. My kids have graduated college. My income stream now is Social Security. Why should I pay this life insurance bill if I'm not going to leave my kids an inheritance anyway? And you can call up the life insurance company and they'll offer you to buy you out. They'll give you a payment to surrender your life insurance policy. And it's usually like $50,000 or something like that. And this is US only, because there was a Supreme Court case over 100 years ago that determined your life insurance policy is an asset that you own. In Canada, it's a contract they can alter. In the United States, it's an asset you own. A third party will buy your life insurance contract. And Abacus Life pays about 7 times what the life insurance company will surrender. So if the life insurance company says, we'll buy you out for $50,000, Abacus Life says, well, how would you like $350,000 for your life insurance policy? And that's a sizable chunk of cash that will actually make a difference in somebody's life. So if you don't, if your adult children have graduated college and they own their own homes, or, they've made the down payment and they have a mortgage on their own homes, and they are not planning on an inheritance, and you think $350,000 is going to change the quality of your retirement, it's fantastic, because most people just stop making the payments and the policy just lapses and they lose whatever they put into it. So that's a fantastic business, and it really hasn't penetrated the market. Most people still have no idea it exists. They really need to just teach the market that they exist. And it's a fantastic business. It grew, I think, 83% revenue year over year revenue growth. It's a massive, rapid growth story because the demand is there. These baby boomers don't believe in inheritance. Why they can turn a monthly bill into a big lump sum payout, and that swing is very attractive to them, because what is $1 million going to do for you when you're dead? That would go to your estate, which would be nice for your estate, but $50,000 is kind of nice right now also. You can go on Royal Caribbean and Norwegian cruise lines. I have an uncle who he calculated all the day. He retired when he was 48. He was the CEO of a hard drive company in California. He added up all the days he was out to sea. It's over 4 years he spent on cruise ships now. It's crazy stuff. How many buffets and how many bad comedy shows can you watch in a lifetime? I don't get it.
Yeah, that's my mum's in that stage at the moment. Well, she looks at me and she says, well, you're not getting any inheritance. So she's having a wonderful time traveling around the world. She says, look, you do it at 34. Why can't I do it at 65 or 66? Tomorrow, mate. Tomorrow is the birthday for the mother. So we're going to do something fun. I really like the theme, and it makes an awful lot of sense. Abacus Life, if it's growing its revenues at 84%, the market's not buying it, mate. They're not. There's no love. There's no love. Life insurance company. I'm shocked.
Yeah. So there was a short report, and I wrote on my Substack a argument against the short report. I don't think the short report had. I don't think there was a lot of substance there. It was all smoke, no fire. There are some good when short reports are done right, they're very good, but a lot of it is just character defamation in a country where we don't really prosecute character defamation very much anymore. And this is off topic, and you said you were going to try and keep me on topic more, but if you go back to
Let's go, mate.
So there was a lawsuit. Jesse Ventura, former governor of, I want to say, Minnesota, former World Wrestling Foundation actor, former Marine. We had this sort of a folk hero called the American Sniper, and he was a fraud. And even some people still don't even know he was a fraud. He wrote a book where he claimed that at a military anniversary banquet, he got in a fist fight and he beat up Jesse Ventura, which was a lie and defamation. And Jesse Ventura sued the guy when he was found out to be a fraud. He died in an accident, which was probably suicide because his world collapsed. But Jesse Ventura was suing the publisher and the estate. And what was amazing about it is the amicus curiae brief, so the friend of the court briefs that came in from the major corporate media institutions in this lawsuit, where the major corporate media institutions said, look, if we can't defame people all day, we'll go out of business because that's what we do for a living. It was just this amazing world where the case law in the US now is just defamation is okay and just go ahead and do it. And so some of these short reports are just miserable. So, I mean, there are some problems in Abacus life. So, for example, the three founders, and the same thing happened in Carvana. So the chairman of the board, the father of the CEO in Carvana, he was convicted of he pled guilty to a felony when he was in his 20s, like 40 years ago. So you have to say, well, the guy on the board has a felony in finance, and that is a big deal, right? Well, when life insurance settlements were young, the regulators seemed hell bent on putting them out of business. And so there are cases where and I looked at it pretty thoroughly. The three founders of Abacus Life have some decisions against them. And then I looked at that, and I looked at the industry as a whole, and everybody in that whole industry has decisions against them. Their major competitors have decisions against them. So I think it's a situation where the regulators were trying to crush this because the life insurance companies were big and powerful and had money. And it took about 15 or 20 years before the regulators said, wait a minute, if 90% of life insurance policies never pay out, isn't it good for the consumer if somebody's giving them some money? And so I think the regulatory environment after 15 or 20 years has finally changed. But there is some arguments, hey, the three founders of this company have legal decisions against them and regulatory decisions against them, which, by the way, is true for all of their competitors, especially the ones that are talking smack about them in the short report, who has much, much larger and much worse decisions against them. So it's one of those situations where, is everybody in that entire industry a scoundrel, or was it the power of the life insurance lobby who was able to use the regulators to crush their competition? And I think you have to, there wouldn't be an opportunity in the market if there wasn't disagreement. But I think there is still some stigma that life settlements is a world full of scoundrels. Well, look, if the insurance company is going to pay you $50,000 and Abacus Life is going to pay you $350,000, I have a hard time looking at them as the scoundrels in this whole scenario.
Yeah. My grandfather used to say, better the scoundrel that pays you 7x than the scoundrel that pays you 50 grand. So yeah, it's an interesting one. Defamation, mate, we're at the complete opposite end of the spectrum here. We're not a free country. So you can, if you write an honest Google review that your service wasn't very good at X service provider or local restaurant, whatever, then there have been a few cases where they've successfully had defamation. And so that really defeats the purposes of this peer-reviewed process. But anyway, there you have it. Abacus Life, Jackson Financial, Finance of America, very, very solid themes inside a very solid sector. And speaking of older people, inheritance, my mother, one thing she should be grateful, Stephen, I forced her to buy some gold several years ago and she didn't know anything about it. But anyway, she did thankfully listen to me. And so all of a sudden her fixed income pension is being rapidly eroded, but at least she's got her gold. And gold has been shining this year, mates. The gold bugs are happy. What is going on in terms of the rest of the commodity market? If we move into our commodity corner, what say you? Are you of this opinion that gold leads and then the rest of the commodities, particularly, I guess, oil, the oil bulls are hoping that oil breaches the gap? How do you see the commodity market generally at the moment?
Well, happy birthday, Ben's mom. That's important. So this historical correlation where gold leads and the rest of the commodities follow, I'm very suspicious of those historical correlations unless somebody has a plausible channel and explains why. And especially where the gold rally, people are mad at gold miners. The gold bug community is small and they also tend to be older. And they remember the last gold rally where the gold price rose and the gold miners lost money. Because the gold price rose because the costs of mining were rising faster. And we're in an environment now where the gold price is rising because the central banks are buying, because in a world without trust, it makes a better money than Chinese yuan or US dollars. And the percentage of central bank assets in gold is going up every year. And I think possibly will go up every year for the next 10 years or longer, who knows? So if I don't hear a good reason why gold leads the other commodities follow, I'm kind of suspicious about that. But I do think a lot of commodities have some serious catching up to do with. I've got some more charts for the viewers if they like that sort of thing. If they're not listening in their car while they're driving.
We love a little chart porn. Yeah, nothing worse. You're listening to a podcast, you're in the gym or you're driving. You're like, damn it, I can't look at this chart.
Yeah.
Anyway, you can
So
always.
this is the gold to oil ratio, and there's two things about it. One is there's a clear trend from 2008 onwards, and 2008 was before we seized Russian assets, right? This was before some of the challenges to U.S. global hegemony. But you have this trend where the gold oil ratio has been increasing since 2008, but it has spikes and valleys. And so, yes, the gold oil ratio has been increasing, but we're also probably on a spike and this makes it look like the gold oil ratio could fall from, 60 barrels of oil to an ounce of gold to back down to 30. So that means that the price of oil could double or the price of gold could get cut in half. And I think it's much more likely the price of oil would double than the price of gold could get cut in half. And then
Counterpoint to that, mate, sorry to interrupt, would be Luke Groman's idea of that relationship and everything that made it work in the past is no longer the case because now gold has been rediscovered as the global reserve asset. So we're not really valuing things relatively, at least not yet, because everyone, as you mentioned, central banks around the world are buying up gold, and the relief valve is going to be gold at the moment, at least, away from the US dollar. Now, your next point, I'm sure, will be, yeah, but the cure for low prices, both nominally and relatively, is in fact low prices. And where are we at today? I haven't checked because I just woke up at $70 WTI or something like that.
yeah.
That's
And
that's not really encouraging more production, right?
the rig counts are falling, the frac fleets are falling. Shale oil has been the only oil growth for more than 10 years. So the rest of the world has barely drilled for enough traditional oil just to maintain production, because oil keeps, you've got these decline rates in traditional or in shale. The wells decline, whether it's 5% a year or 3% a year or 12% a year or 20% a year. Everything declines and you're on this treadmill. So yeah, what I've posted is just a graph of just a breakdown of oil prices, and it's a dromedary camel. It's a two-humped graph. It's a bimodal distribution where there's no middle ground. You're in supply destruction or you're in demand destruction. And we have been in supply destruction, and it's a commodity. So someday we'll be in demand destruction. And the next time we're in demand destruction, that looks like the middle of that curve is at $130 oil. And we do stay in supply destruction more than we're in demand destruction. But yeah, it's a commodity. It has this declining treadmill, and someday we'll be in demand destruction pricing again. And when we're there, I want to own some stuff in the energy and the oil services complex. Now, if there's a longer, so looking back to the 1970s when we were really, really short of oil in a bad way, and we had really let things get so there are some bears saying the Permian is rolling over, production's really going to fall off a cliff. This is 1970s version 2. I don't know if I believe that argument, but if that ends up being correct, when that happened, Schlumberger, however you pronounce it, their market cap got equal to Exxon's in the 1970s, because when the whole world had to stop and start drilling for more oil, then the oil services companies dramatically outperformed the oil drillers. So that's why I like some of the oil services companies even better, especially I don't like the fast decline shale. There are some nice slower decline oil companies I do like. One I haven't written about for a long time, but it's in the Gulf of Thailand. It's called Valiura. It's a very small cap oil driller, and I've got an old write-up about it on my Substack. But other than that, I like my ProFrac Holdings ACDC. I like my Transocean. I like some of the smaller ones that sell, they sell explosive charges, or they sell pipes, or they sell all the different things you need to keep on drilling. And I think, I don't know if this is a 2026 story or a 2027 story, but at some point, You leave supply destruction, you go to demand destruction. I think a lot of it is going to come down to so this is all going to be tied in with just a general global economic expansion and interest rates. We're entering a global cutting cycle. The Federal Reserve is cutting. 20% of trucking is the housing construction market. So, and you've got a president now in the United States who is determined to unstick the housing market, and he's determined to cut interest rates. So, if you cut interest rates to the point where housing is moving again and trucking in the US is up 20%, I think you're going to find that we go from supply destruction to demand destruction relatively soon. I don't think this is a 2029 story. I think it's going to be at some point within the Trump administration, we'll spend some time in demand destruction pricing to his chagrin because he wants, cheap oil prices. You can't always get what you want.
Yeah, I think that was that a Mick Jagger song or something like that? You don't
I
always
think
get what
that's Rolling Stones. Yeah. Can't always get
Okay.
what you want.
Yeah, I hide my age very well. No, so a couple of points there, mate. So I agree. I thought 2025 was what I was basing. I thought we'd move closer to demand destruction. I thought we'd have these inflection points in day rates, particularly for the offshore service guys. And I think we'll have our day. So we can talk about offshore in terms of a preferred way to express the theme, only because I thought that was the easiest way to get an estimate of replacement value. But getting from here to there, so getting from these doldrums, these continual disappointments and bad capital allocation from management in the producers made me kind of reappraise my approach 2 to 3 years ago. And I just said, you know what, all this is going to happen on land. It's going to happen to land owned by the royalty holders. So I'm going to buy the royalty holders, chill out, and then barbell it with the oil services co's. So that has been worked out to be quite a good decision. And it's also reduced my stress levels, which I find is an underrated benefit. We're going to move into sort of the tier 2, tier 3 acreage in the Permian because there's not a lot of tier 1 left. And that's going to mean we have more gas, you would think, because they tend to be gassier shale rock. What's going on in terms of this gas market? Because that seems to have a lot of potential to the upside. End of this year, I believe we're getting billions of cubic feet more demand come online because we have more LNG terminals. How do you see gas market?
Well, gas is natural gas. They call it the widowmaker. There are other commodities people call the widowmaker too, but I think natural gas kind of gets the number one position for the widowmaker because it's so volatile and it can go to such extremes. So I'm reluctant to have an opinion on natural gas generally, but I do know that the associated gas from shale, there are data centers for artificial intelligence that want to locate there to use that natural gas to power their facilities. And that's, you also have GE Vernova and Siemens saying that it's a 5-year wait to get new gas turbines because they're not going to increase capacity. Mitsubishi is increasing capacity, so they're willing to risk capital to take that market share, but not GE Vernova and Siemens. So you've got this world where we're going to be making all this gas. Then are you going to build more pipelines to get it to the export terminals? It's a lot of infrastructure required to ship that gas. But the shipyard order books are full of LNG carriers, the vast majority of them signed long-term contracts. So there's going to be some offtake, but the prices are set on the margin. And to be able to calculate the margin when the demand is so variable, you also have this phenomenon where some rules under the Biden administration from the EPA made it less attractive to use natural gas for baseload electricity as Texas was building out a lot of solar capacity. So you might see some rule changes to use more gas for baseload electricity. You might see this artificial intelligence data center demand go up. The export terminals are coming online. And also, we had 3 warm winters in a row, which shocked me. So I've been a longtime shareholder of Vermilion Energy for their natural gas production in Europe, and it has not worked out very well. But 3 consecutive unseasonably warm winters was a surprise to me. And I think it could be due. So there was an underwater volcano in Tonga, the Hunga Tonga volcano, put so much water vapor into the upper atmosphere that it caused some people say the effects might go on as long as 8 years, but it looks like it's already cooling off. We had at the end of August, it was 1 degrees Celsius for you Australians. It was 34 degrees Fahrenheit at night at the end of August in Pennsylvania. This is extremely cold stuff. So we might have our first cold winter in 4 years. as this water vapor finally works its way out of our upper stratosphere. So yeah, if you have artificial intelligence data center demand combined with export terminals, combined with an actual cold winter, prices could go nuts. But it's a widowmaker. The prices can really go all over the place. There has been, so if you look at the rig counts for frac fleets and for drilling rigs, the one place where it's been growing is the Haynesville, and the Haynesville is a pure natural gas shale basin. But the export terminals are coming online.
Meme you sent about natural gas management just plowing it back into production again.
Here's some profits to return money to shareholders. They just go, let's do more rigs. And what are you going to do? It's one of those, they're in a prisoner's dilemma problem. They don't want their competitors to take market share, so they all crush the price. But because natural gas can't really be stored except in very expensive forms, then when there's a shortfall, the price goes absolutely astronomical. And so we're going to see, $2, $8, $2, $8. But the large long-term contracts have been at $4 for a long time, which is a pretty reasonable price for natural gas. So the spot price is not everybody's dealing in that world anyway, but natural gas is a widowmaker. I like the picks and shovels. I like the services, but the market hasn't liked them very much either. But the time will come. Energy will have its day.
Yeah, once again, I return to the theme of owning the land and royalty holders that simply get their gas. At the moment, it's being priced at negative. If you look at Texas Pacific, a lot of their quarters, the Waha is, negative Waha is dragging on their earnings. But with pipelines opening up now from Texas to California, they're one of the few that can actually capitalize on that. And, it works out to be, if you just flip from negative Waha to slightly modest positive prices, you're not having to pay to wait for that. And when that inflection comes, it means, tens of millions of dollars added to the bottom line, in addition to the capital light business. But anyway, mate, no one wants to hear me bang on and on about the royalties. We want to hear about buying options on Open. Open seems to be extremely topical. I listened to Anthony Popoliano talking about it. Why don't you give us the rundown on Open? There was some juicy premiums in the options market that I decided to participate in. I didn't buy the options, probably should have. I sold on the other side, not the call side, on the put side. What's the go with Open? Why has it dropped from like $30 down to 50 cents and then back up again like a bungee jump?
Yeah, so Opendoor, I wrote about this June of last year. So on my Substack, you can find my original write-up on Opendoor from June 2024. And Opendoor, I found 3 companies that had the genuine possibility of being 50 baggers. And those are so rare that I kind of argued in my portfolio, my model portfolio, that look, if you flip a coin and half the time it's a 0 and half the time it's a 50x, you kind of got to play that game, at least with 1% of your portfolio. Opendoor, also Cardlytics, and Teladoc might only be maybe a 20x, but I wanted to write about them in 3s anyway. But there were a couple companies that had a real genuine capacity to be a 50 bagger. And the thing about Opendoor is, so they're an iBuyer. If you want to sell your house, you can go through a real estate agent, and it'll take you a month, and it's miserable and it's a torture. Or you can go click a button online and sell your house, and you'll get somewhat less. The problem with when I wrote about Opendoor and also Cardlytics and also Teladoc, the problem was management. That in the world of tech, you really need a CEO who is iterating quickly and solving problems. And that was, so I was able to buy Carvana for $3.92 a share when the day CarMax missed earnings. And the thesis was, this guy, Garcia, what's his name? I'm forgetting his first name, but the CEO, if you listen to him on earnings calls, and I have a math background from when I went to college millions of years ago, but listening to Ernie Garcia III on conference calls when his stock was really under pressure, when he was answering questions about how are you going to flip to profitability, and he was describing the math involved for inventory control and all these things, you could tell that he was a genius. This was a 160 IQ guy who had just incredible command over every aspect of his business and very complicated math to get his company where it needed to be. And that's what you need from a tech CEO, is somebody who is brilliant, iterating quickly and solving problems. And Opendoor didn't have that. And I'm not here to talk smack about some lady that I don't know, but they had management problems. As we got closer to interest rates being cut, the market figured out that the president wants to unfreeze the housing market, and the president is extremely, surprisingly successful at getting his way. So you've got somebody who is just shockingly successful at getting his way, and he is dead set on unfreezing the housing market. And when that happens, Opendoor is going to be a direct beneficiary. There are some squeaky wheels in social media getting a lot of attention for the stock, which actually, I saw an estimate that amounts to about $40 million a day of free advertising value. The people on Twitter who are talking about this stock endlessly, because that was what happened to Peloton. They ended up selling more bikes because the stock was so popular. So you have, and you can already see it day to day, their sales are improving as they get free advertising from this stock pumping. But much more important than the stock pumpers is that about 30% of the company is still owned by venture capital. And venture capital, entrepreneurship was always kind of perceived as this mysterious character that, shirt sleeves to shirt sleeves in 3 generations, you just can't teach it, Colonel Sanders had it, he was bankrupt at 60 and a multimillionaire at 80. Like you're a serial entrepreneur, you just have this thing about you. But venture capital figured out how to professionalize entrepreneurship. They can teach people to be entrepreneurs, they can iterate quickly, or they can find people that are entrepreneurs and put them in leadership roles. And 30% of Opendoor is still owned by serious venture capital. One of the co-founders of Opendoor, his name is Keith Raboy, or I don't know how to pronounce his last name, but he's the managing director of Kozla Ventures, a venture capital firm with $16 billion of assets under management. And I am 100% sure that he has enough shareholders of Opendoor on his Slack channel that he can communicate with at all times. Like, he tweeted, the current CEO will be gone, and a week later she stepped down. So while everybody is focusing on this very vocal stock pumpers, there is very serious, sophisticated money who see that interest rates are being cut, who see that this company is... So the housing market, people don't really appreciate how big it is because GDP is about goods finished this year. But existing homes, they trade hands every 7 years. The housing market in the US is a $2 trillion annual market. You'll say, oh, well, the GDP of the US is only like $28 trillion. That can be right. They're not built this year. They're existing goods. It's a $2 trillion market. If you look at Uber sitting in the middle of taxis and food delivery, yeah, that's an okay market. If you look at Carvana with the capacity to sit in the middle of used cars, yeah, that's an okay market. If you could sit in the middle of a $2 trillion housing market, and you could be the network good that everybody needs, if you could be the Uber of housing, that has the capacity to be a $1 trillion company. Has the genuine potential to be absolutely incredible. And the customers like it. They do have some software problems to work out because they've been governed by these bureaucrats for so long. But if you look at their oldest market, which is Phoenix, Arizona, just by word of mouth, just from people enjoying the service and telling their friends, they have 5% market share in Phoenix, Arizona for housing transactions. So the customers like it. The customers tell their friends about it. Now they're getting enormous free advertising. There are some serious professional entrepreneurs who are going to take control of this thing. And not everything can be a network good, but real estate, people want to list their houses where the buyers are, and the buyers want to go where the houses are listed. So just like with Uber, people want to hail the taxi company with the most drivers that are closer, and the drivers want where the passengers are hailing the most taxis. SoFi isn't like that. Banks aren't like that. You have zero benefit from using the same bank as your friends, right? It just doesn't matter. Now, SoFi is growing. They want to become a top 10 bank, but they're not a network good. Opendoor has the capacity to be a network good on top of a $2 trillion market. And that's insane. And if you don't have a small allocation to that, then you don't like money, I think, is the only answer. Because, yeah, they could fail. They could go to zero. But if they're successful, I don't know if it's still a 50x from here at $6. Maybe it's a 20 or 30x from here over the next 10 years. But the odds that they're going to be successful has just shot up through the roof because entrepreneurship is no longer getting struck by lightning. Entrepreneurship is now professionalized and taught. And I think you're going to see Opendoor is going to have, a change of a couple of board directors. They're going to get a CEO who's extremely high caliber. interest rates are going to be cut. They're going to do the year of efficiency that tech has done. They're going to cut headcount by at least 50%. They're going to switch to net income profitability, and it's going to knock everybody's socks off. That's my prediction. Or it could go to zero, but it's a fantastic coin toss. You want a $1 trillion company or zero? And I wrote about this June of last year. And just as soon as we got visibility on interest rate cuts, it showed up on Reddit, and a bunch of retards piled in, and now it's going to the moon. Now it's just hold on to your seats.
Entrepreneurship is now being codified and taught. I like it. Interesting. Interesting, Steve. So, okay, it might go to zero. Well, what if it doesn't? What if it's not so binary? What if it does carve out a little bit of a market share? So I'm thinking here, locally, it's a duopoly. You've got Domain and you've got the REA group, realestate.com. If you want a house, you just have to look on both of those, really. I mean, they're basically everyone who's listing lists on both options. How nice would it be to sell your house just to Opendoor and then let them worry about making a profit after that? Is that basically the business model? Like they give the buyer the cash and then they go and resell it? How does the actual model?
So that was the traditional business model. It's called iBuying. They will buy the house. There is a problem with that business model, and it's an academic paper from a million years ago, George Akerlof, The Market for Lemons. And the idea is Opendoor can know the square footage of the house. They can know how many miles you are from the school district and what the quality of the school district is. They can know how many bedrooms and how many bathrooms, but they can't tell if it has curb appeal. They can't tell if it has a good layout. They can't tell anything qualitative about it, which means that when you have a situation, do you want to put your house in the market and try and get higher than this offer, or do you want to take Opendoor's offer? Well, the people who want to take the offer, they have lemons. And so Opendoor gets too many lemons in their fruit basket. Now, that didn't matter while home prices were rising. But as soon as home prices flatlined or fell, Opendoor lost about $1 billion. Zillow lost $900 million doing the same thing. Zillow left the market. They said, we're done. We're never going to touch this again. And then they partnered with Opendoor. So now on Zillow, you can sell your house to Opendoor. Their largest potential competitor became a sales channel. And the same thing with Redfin. Redfin lost about $50 million and said, nope, we're not going to do iBuying. Now, when the original founders left the company in the hands of the bureaucrats had a different vision. They were trying to shave off a percentage point here and there. They were trying to go low risk, capital light. They wanted to just replace brokers and just clip 3% sales commission, but not take any risk. And that's how they've been sort of break even or slightly melting ice cube for a couple of years, because these bureaucrats were risk averse and they went capital light. When the venture capital crew gets back in there, they're going to use artificial intelligence to look at pictures of houses and estimate curb appeal. They're going to use LiDAR drones to do mapping out floor areas and figure out, okay, no broom closet, yes, broom closet, no linen closet, yes, linen closet, bad layout, good layout. And they're going to use artificial intelligence to overcome some of those qualitative estimates that made too many lemons in the fruit basket. And I think they're going to go back to making big fat margins again. So a lot of these problems can be solved by AI, and they have enormous incentive to solve them. And again, I'm not just making all this stuff up. So one of the co-founders of Opendoor is on Twitter talking about all of this stuff, which to me is mind-boggling. How, he's tweeting on Twitter, she will not be the CEO anymore. A week later, she's gone. Same thing with, right now they have an interim CEO, and he pretty much flatly said he's not part of the turnaround strategy, that they are going to put somebody else in there, that they are going to cut headcount by 50 to 80%, that they're going to flip to net income positive. Like the managing director of a $16 billion venture capital firm who owns 2% of the company is telling you this on Twitter. It's amazing. I've never seen that kind of transparency before. Now, he could be unhinged. He could be taking mushrooms. So, buyer beware. He could be wrong. He could be insane. But it looks to me like it's the real deal. And it looks to me like it's extremely transparent and an amazing opportunity. And the market has been responding. It's gone from 50 cents to $6.60 in the last couple of months. And I was on vacation when it started moving. I wrote 3 articles on vacation. I didn't bring a laptop. I just, with my phone, I took a picture of my coffee mug and said, hey, take a look at Opendoor. I wrote about it last year. This is a big deal. So I think I was able to tell my subscribers about it when it was still at about $1.50. And because I hope everybody makes money along with me. I believe in mutual benefit.
I like it. No, I'm certainly grateful. Otherwise, it would not have even come across my desk. It's not in a sector that I usually pay attention to, but very, very interesting. And sounds like this guy behind it, the VC, is a true entrepreneur. As you say, mate, we're coming up on the hour. I can talk to you all day, but then we're already pushing our luck with Mrs. Value Degen, taking time away from the fam. What do you want to talk about? Is there anything you want to kind of close with for this last 5 minutes?
We've touched on a lot of bases, that flip where the buyers of options are making money off of the sellers and where the volatility is so large. I would just say that it's never been more important to know what you own, to have small positions in a lot of things and wait for the dip to come. Don't have, fear of missing out and just say, hey, they're going to have a bad earnings call one of these years. And when the stock price falls 40%, I can load up the truck. And because if that pattern maintains, then it's going to be a world where things move too fast. You won't be able to act if you don't already know the company. If you haven't already done your due diligence and say, you know what, Fox is an amazing business and they're growing 30% year over year in China, which nobody else can do because the Chinese are known for knocking off brands, and for Crocs to be able to master social media marketing, to get Chinese influencers to wear their shoes and to have all the women in China want to copy them, and not for the Chinese made alternative, is magic. And to understand that this company is doing magic and then the stock price sells off 25%, you got to know it before these huge price moves you can act, because there's not going to be time to wait around when things move that fast. So I think that's, I could be wrong. It could go back to normal next quarter, but I think this is a structural shift that, again, this graph popped up on Twitter and nobody shared it. There's a lot of graphs that 100 people retweet. And this was just not one of those. I don't think people realized how big of a potential sea change this is. And aside from that, it feels like, I don't know if gold is going to have a pullback because central banks are buying, but I've seen a lot of signs at the top. I had three of my subscribers at the same time reach out and ask me to look at the pre-revenue junior miners. And when that many people reach out and want to get involved in a pre-revenue junior miner, gold could easily have a pullback. And in oil, it's one of those situations where it can't stay in supply destruction forever. So when I look around the world and I say, what's cheap right now? Energy, healthcare, and maybe some consumer discretionary names. And consumer discretionary has been running. So I think the smart money is starting to pile into consumer discretionary in these rate cuts. I think the smart money sees that the economy is about to boom because money. So some of my long dead consumer discretionary names have started getting big inflows. So I think that the smarter money is figuring out that we are maybe 3 to 6 months away from these rate cuts and also tariff certainty. Uncertainty paralyzes business plans. There's a lot of earnings calls where people say, look, we can't see 6 months ahead of us, so we're not going to do this play. We're going to hold off on CapEx for 6 months. Once the last tariff negotiations are in place and people say, okay, now we know what the economy looks like and we have rate cuts, I think hold on to your butts because this is going to be, I think, a pretty wild time. There's people that think we're heading into a recession and the GDP of the US is growing at 3% year over year in real terms, close to 7% nominal terms if you believe their inflation numbers. 7% nominal GDP growth, and people think we're heading into a recession. There's such a disagreement in the market. But I think some interest rate cuts and some tariff certainty, and it's just off to the races.
Yeah, I don't think everyone's going to benefit equally from that. You touched on because I don't think the margins of the Mag 7 are going to maintain themselves. But anyway, that's a subject for another day. You mentioned healthcare. The outflows of healthcare ETFs have been almost on a par with energy. It's been insane. And I think it was about maybe 2 months ago, 1 month ago, I started to put the word out there that I was opening up the royalty thesis towards healthcare and pharmaceuticals. And the average stock there that I've got in my little basket is already up sort of 45% for capital light beneficiaries. I mean, really, really strange times. Mate, thank you as always. It's been a pleasure, guys. Unemployed Value Degen Substack, humongous value on offer there. Links in the description. Look forward to catching up with you for another episode of the ROI channel. Take care.